where we're going to completely demystify the financial markets. Look, if you've ever stared at a price chart and felt like it was just this chaotic mess of green and red lines moving completely randomly, or man, worse, if you've ever bought a stock only to watch it instantly crash right after you hit buy, I promise you, you are not alone. But today, we're stripping away the jargon, we're cutting out the confusion and all the noise. We're going to master the actual underlying mechanics of the market through the lens of supply and demand. By the time we wrap this up, you're going to be looking at charts in a completely new, incredibly structured way.
So here's a question for you. Want to trade alongside the big banks? Because honestly, that's the ultimate goal, isn't it? The markets aren't actually driven by you and me buying a few shares on our phones. No way. They're driven by massive institutional algorithms moving literal billions of dollars. We're talking hedge funds, the major banks, the smart money. Mastering supply and demand isn't just about, drawing random lines on a screen. It's about tracking the physical footprints of that smart money so you can ride their massive liquidity instead of just becoming a victim of it.
Okay, here's our roadmap for this explainer. First, we'll uncover the smart money secret. Then, we'll go over exactly how to draw your supply and demand zones. Third, we're going to break down the sniper trading strategy. And finally, we'll cover why some zones fail.
All right, let's kick things off with Section 1, the smart money secret and how you can escape the retail trap. To really wrap our heads around supply and demand, we have to recognize that the markets are basically a continuous battleground. We have to learn how the pros operate so we can stop falling into these traps designed for beginners. Just look at the typical retail trader. Sweaty palms, heart racing, they see a massive green candle and get this crushing sense of FOMO, the fear of missing out. So what do? They panic buy at the absolute top of the move. And what happens next? Well, the market inevitably pulls back to retest lower levels, and these beginners get completely stopped out. Now look at smart money. They operate like an owl, just utterly patient, cold, calculated. They let that explosive move happen, then they just wait for the price to calmly retest the original demand zone, and that is exactly when they enter, using deep liquidity. You definitely want to be the patient trader here.
And this behavior, it creates very distinct market cycles. Any market out there, Forex, stocks, crypto, whatever, moves between periods of balance and imbalance. Balance is when the market is consolidating, it's choppy, it's slow, buyers and sellers are basically playing tug-of-war to a tie. But eventually, just like a rubber band pulled way too tight, it snaps. That snap is the imbalance. It's an explosive momentum move where the price becomes completely inefficient. And here is the real secret. Supply and demand zones are born exactly at the moment the market transitions from that boring state of balance into a violent state of imbalance.
Moving on to Section 2, drawing supply and demand. This is your visual blueprint. Okay, knowing the theory is great and all, but we actually need to put it on the chart. And the beautiful thing about this blueprint is that it works on literally any time frame, from a 5-minute chart all the way up to a weekly chart. So here are your 3 non-negotiable steps. Step 1, identify the explosive momentum move. You're looking for those gigantic, long candlesticks that just scream massive buying or selling pressure. Step 2, look backward to find the single, usually smaller candle immediately preceding that massive move. Think of this as the base right before the explosion. And step 3, draw a box around that preceding candle. Now, the crucial point is you absolutely must draw this box from the very top of the wick to the absolute bottom of the wick. Why? Because those wicks are the literal footprints where smart money grabbed liquidity before driving the price away.
Now, as you start scanning your charts, you're going to see these zones take one of 4 common shapes. For supply, which pushes prices down, you have the rally-based drop, where an uptrend stalls and crashes, and the drop-based drop, which is basically just a pause in an ongoing downtrend. On the flip side, for demand, which pushes prices up, we have the drop-based rally, where a downtrend reverses, and the rally-based rally. Look, don't sweat memorizing these exact names perfectly like it's a textbook exam. Just train your eyes to look for the pattern. A fast move, a brief pause, and an explosive move. That pause, that's your zone.
All right, heading into Section 3, the sniper trading strategy. Let's talk precision execution.
Getting this right requires some really strict rules. First off, your entry happens only when the price returns to touch your drawn zone, no chasing.
Your stop loss, that goes completely outside the zone. If it's a supply zone, tuck it just a fraction of a percent above the top to give it some breathing room. Now, your take profit should always be the very next opposing zone. If you buy at demand, target the next supply zone. And hey, here's a really fantastic risk management trick. Once the price rejects your zone and actually starts moving in your favor, trail your stop loss just outside the latest high or low. That way, if the zone eventually fails, you're getting out with just a tiny scratch instead of a full loss. When you do it right, this setup gives you an incredible risk-to-reward ratio.
But keep in mind, not all zones are created equal. You're looking for a rocket ship here, not a turtle. A truly high-quality zone is defined by massive momentum. We're talking big, fast candlesticks that leave the base with absolutely zero hesitation. The fewer candles it takes to make the move, the stronger the zone is. On the other hand, low-quality zones feature small, choppy candlesticks and slow, grinding movement. If you see a zone where the price just lazily drifts away, just ignore it. Sheer momentum is your absolute best indicator of institutional involvement.
Trade like a sniper, not a machine gun. Seriously, write that down and tape it to your monitor. Profitable trading isn't about sitting at your desk sweating, firing off trades at every little tiny flinch of the market. It's about hiding in the weeds, just waiting. Let that absolute A+ setup walk perfectly into your crosshairs, and only then do you take the shot.
Let's wrap up with Section 4, Why Some Zones Fail. Think of this as your personal troubleshooting guide.
First things first, we got to accept the harsh truth here. No strategy works 100% of the time. Period. Honestly, if anyone ever tells you they have a flawless trading system, they're lying to your face, and they're probably just trying to sell you a $5,000 course. Losses are just an inescapable part of the game. Supply and demand zones will break, smart money liquidity will dry up. Our job isn't to be perfect. Our job is to mitigate risk and recognize the warning signs so we don't get caught flat-footed on the wrong side of a failing setup.
To do that, I want you to use this matrix as your ultimate defense mechanism. There are really 3 specific reasons zones fail: market structure, depth, and time. If you're trading against the overall market structure, you're just setting yourself up for failure. If the depth of the price penetration into your zone goes way too deep, that's a huge warning sign. And if the price spends way too much time just stalling inside the zone without rejecting it, it's probably about to break. Let's break these 3 factors down a little more carefully.
All right, first up, market structure. The basic rule of thumb here is pretty simple. Buy at demand in an uptrend, sell at supply in a downtrend. You always want to swim with the current. But now what's really interesting about this is there's one fascinating exception to the rule. You can actually trade against the trend, but only under one very specific condition. The zone you want to trade must have already violently broken and completely taken out an opposing zone. So if a demand zone in a downtrend was strong enough to completely shatter a previous supply zone, well, it means the trend is reversing and it's safe to buy. But if it hasn't broken opposing structure, stay far away. The next factor to watch out for is depth. When price eventually returns to retest your zone, you want to see a quick, shallow tap before it reverses. The deeper the penetration goes into the box, the weaker the zone becomes. Think of it kind of like a wall of ice, right? Every time the price hits it, it chips away a little more. If the price pushes past the halfway point, you need to proceed with extreme caution. And if it touches the very back edge of your zone, well, the institutional liquidity has likely completely dried up and it's almost certainly going to break. The key here? Don't just predict that a zone will magically hold. React to the actual price action happening right there inside the box. And the final factor is time. A high-quality institutional zone should cause a violent, rapid rejection. Usually, you want to see the market react within 1 to 2 days on a standard chart. If the price re-enters your zone and just kind of stalls there, consolidating and chopping sideways for 5 or 6 days, the explosive energy is completely gone. When you see time dragging on inside your zone like that, don't sit there hoping for a miracle. Take control, cut your losses early, and exit before the bottom just completely falls out. Which brings us to our final thought. The mechanics of supply and demand are pretty simple, but the discipline required to actually execute them, that is incredibly rare. We've replaced the chaos of the charts with a completely logical blueprint based on balance, imbalance, momentum, and strict risk management. So I leave you with this. Are you ready to stop clicking buttons out of pure FOMO and actually wait in the weeds for your perfect setup? Because the smart money is leaving footprints all over your charts right now. The only question is, what other hidden traps have they set that you haven't learned to spot yet? Thanks for joining me on this explainer, and I'll see you on the charts.